Cholamandalam Investments is on our radar. Third quarter performance were more or less in line with the numbers. Disbursals were very, very healthy. AUM growth was also quite healthy. But is there a bit of a hiccup on the asset quality? What are the trends going forward? Well, let's discuss this with Mr. Arul Selvan, who's the president and CFO of Cholamandalam Investments. Sir, thank you very much for joining in. And I was looking at the numbers. It's absolutely phenomenal, right? The kind of AUM growth that you've had, you're growing in your 30s, and that growth is coming across all parts of the book. The vehicle segment is up about 22%, LAP and SME 39%, home loans are growing at 42%. So it's all very good. But the question is that do you have any concerns around some asset quality issues? There's a slight increase in gross NPA. Credit cost, I think, is at 1.4. And your provisioning is much, much higher. Year on year, provisions are up, I think, over 90%. What are you expecting on asset quality?
The asset quality is, is little bit of under, higher levels in vehicle finance and also in the consumer and small enterprise loans, which is unsecured segment, where you are seeing some amount of asset quality. Part of this is mitigated by the FLDG, which is coming in the income line of the CSL, but it's not a large number. Yes, overall, there has been a bit of a higher levels of stress in both vehicle finance and the CSL. The other aspect that you need to factor in is in both the LAP and HL, last year we had reversals of NCL primarily arising because of the accumulated NPAs during COVID getting resolved through the SARFAESI action, thereby giving us a negative NCL, which is now coming back to normalcy. And so year over year, you may seem that it has been an increase in these two segments. Otherwise, these two segments are actually doing very well. So
what is, sir? Overall, so if I could just, if I could just complete that. So you're saying the stress that you've noticed is in vehicle finance, and you mentioned some parts of unsecured. What is the total quantum of your unsecured book, and how much is it as a percentage of the total book?
It is 8%, and even in this, it is not all of this 8% is under stress, as you would, we have discussed this earlier. 3/4 of the 8% is under traditional route, which is where we do our own disbursements with our own teams and, not through the fintechs, which is performing reasonably good. The fintech business is where we have seen some stress and which is where we have been progressively scaling down. We have moved it from what we used to do with around 10 fintechs to currently around 3 fintechs. And progressively we'll take a call about continuing with them if the stress levels continue. In the meanwhile, we have built our own app, and where this the fintech, the same approach we have done with our own D2C business, and that book is performing extremely good. And so we expect to build on that book while we progressively scale down on the fintech exposures.
Okay, so given what you've said, that slight stress in vehicle finance and maybe some parts of the unsecured book, on the credit cost front, sir, do we see it rising? I think the credit cost is at 1.4% in Q3. What can you guide? And also gross NPAs, which have now touched 4%. Is this the peak, or could it increase a little bit before it stabilizes?
No, in Q4, it will come down. I mean, this is always the traditional, way it happens. So Q4 NCL and NPAs will come down across all segments, and you will see a reduction. The overall full year NCL should be in the range of around 1.3%. So it will be a reduction compared to what you're seeing by TT December. But it will again move up a little bit in Q1, Q2, but then next year we expect things to be back to normalcy. The NPA number you said is the RBI number. The stage 3 numbers are lower, so that would be at the sub 3%.
Okay. So you're saying that Q4 is better, then again maybe Q1, Q2 see a little bit of a pickup in stress, and then it stabilizes in the second half of the new fiscal. Got that point. So let's talk about then the cost of funds as well and margins. We are in the midst of the beginning of a rate cut cycle. 25 basis points has happened. Of course, the Reserve Bank didn't do anything to lower the risk weights for loans being given to NBFCs. Just how are you
So
evaluating the liquidity environment and the cost of money for you?
See, for Chola, liquidity has never been under any issue. So we are getting money thanks to our reputation and the bank support. So we are having a good amount of liquidity in pipeline also, and so we don't see any stress on the liquidity side. On the cost side, the around 16% of the book is linked to T-bill, and another 8 to 10% is linked to repo. So these 25 to 30% of the borrowings will see immediate impact on account of the repo rate cut. Another 16% is linked to MCLR, where the banks may reduce, but it will take some time, is my view. So they will not reduce. On the fixed rate, yes, the balance is on fixed rate, around 60% of the book, 55 to 60% of the book is fixed rate. There you will not see immediate reduction, but as they come up for, repayments and renewals, you will see the reduction coming. Overall NIMs
overall NIMs, all of this put together, the external benchmark link part of the book, and there's MCLR link, which obviously doesn't move, fixed, floating, all of it put together. What's the outlook on margins?
Margins should hold is what I would conservatively say right now, rather than build up too much hope. These are, little volatile days, so we'll wait for things to pan out. I think Q4 we should hold the margins, and then we will see reductions in the cost of funds coming up in Q1 and Q2, thereby improving the margins.
Mr. Selvan, good morning. Prashant here. I just had a broader question. I mean, you guide very minutely on across parameters, but and I've asked you this before, last 1.5 years, the regulatory whip of the RBI was, it came down hard across the financial sector. And not just that, but in other areas as well. We're seeing a bit of a change under the new dispensation of the Reserve Bank. There's more liquidity, etc. as well, which you alluded to. Will generally things get a little better for the financial, for your industry, for NBFCs? And of course, we've asked that question to banks as well, and the answer has broadly been in the affirmative. Just wanted your sense, sir.
See, I think, I would answer it that if you are doing things right, you will never be in trouble, irrespective of who is at the helm of the regulator, whichever regulator we are talking about. So it's better you keep yourself clean and simple. Don't do complicated things. Then you will have lesser problems. I would rather say it instead of saying this regulator versus this period versus that period.
Okay. No, that's a broader. That's good life advice as well. But so you're nicely. But that's
I think
good.
Politically correct answer.
Okay, no, I get that. I get that. Okay, not okay. Forget the regulatory side of it, right? But more liquidity in different, because it's all interconnected, right? More liquidity, easier conditions for consumers. I mean, it does help your borrower as well. Actually, everyone's borrowers, a little bit of the margin.
Yeah, see, the key is that the capex spend and government spend increase, both in through capex as well as in the rural developments. That would put money in the hands of the consumer, which would in turn spur demand, which is where we will get to have traction with our vehicles, with our borrowings, etc. So the crop has been good, and the projection for the monsoon for the coming year is also reasonably, comfortable. So everything looks very good. The global environment is a little tight with so much of variance, differences that is coming up. But I think we are a little bit insulated from the global influence, but we cannot be completely delinked. So we will have some impact if things go worse. Otherwise, outlook for FY26 seems to be a good, period that is coming up.
So what's that outlook in a numerical sense, sir? FY26, since you touched upon it, what's the kind of growth of the book that you'll target?
We keep our target same level, ma'am, at around 20 to 25% is what I would right now talk about on the AUM growth. And we will certainly see profits also at reflecting this growth as we move forward into the coming year. We'll endeavor to do better, but I think at this juncture, let us keep it at these levels.
Fair enough. We'll work with that, sir. 20 to 25% AUM growth in FY26. And then let's see, once the impact of the rate cuts kicks in, maybe you're saying that margins will also improve, perhaps third quarter onwards. Got it, sir. Thank you very much for giving us that perspective. That's the latest from Cholamandalam Investments. Take a break. Once again, just revising the screen for the benefit of our viewers. 1100 down on the mid-cap index. It's still painful. Nifty is down 1% now. 200 points lower on the Nifty as well. Contrast that with the Hang Seng screen. It hurts even more because the Hong Kong Hang Seng is surging 2%. That's the kind of market that we're in the midst of. Let's take a break, come back on the other side, and we'll be in conversation with the management of Birla Soft. Talk about their third quarter performance.